Hey guys, welcome back to another Sunday video getting ready for the week ahead. We'll be discussing in today's video things like gold. We'll look at indices, which sold off last week. We'll talk about bonds, which yields went crazy last week. We'll talk a little bit of currencies and some more. So as we get started, if you could just hit the thumbs up button or heart the video if you're watching on Twitter. Thank you guys for tuning in. Let's go ahead and jump in. So first off, I wanted to talk a little bit about the US stock market, which sold off pretty aggressively last week. And I have mentioned that I've been on the bullish side of the indices for pretty much all year long. Same thing with gold. I've been very bullish, thinking that rate cuts would be on the way. And here's the caveat. It did seem like this past week that we got pretty solid confirmation across the board from Jerome Powell as well as market data that rate cuts are coming. The problem that kind of introduced itself towards the end of the week on the jobs data, which I discussed thoroughly in yesterday's video, is that jobs were bad, right? Jobs data were really bad. And this changes the tone of the rate cuts that the market is looking for. You know, everybody was excited for rate cuts a week ago because rate cuts meant, hey, the data is cooling off, but it's not crashing and things look pretty good. It's probably time we can start rate cutting and then the economy can chug along. Now we have rate cuts because, well, it looks like the economy is not chugging along. We've got jobs data that is threatening to that idea. And now maybe they're going to cut rates because, again, they need to, not because they can, right? There's two different scenarios for rate cuts. Anyways, that fear came into the market and we saw people just get uber bearish, super terrified about the markets. And I am still bullish. Why am I? And again, I had some comments on yesterday's video because people kind of heard me talking about that. And they were like, Nick, how can you be bullish? They're going to cut rates because it's horrible now. The jobs data looked horrible. And that is true. That data point was awful. In fact, let's talk about that data point just for a second, just for context for maybe people who didn't hear or didn't get the specifics. So jobs data on Friday, we were expecting to add 76,000 jobs. So that was what the baseline for jobs data was. And then we had this number here, this 114,000, which came in much lighter than expected. And that is actually a multi-year low for number of jobs added in an NFP report. So that was really concerning to the market because that looks really weak. That looks like hiring is looking bad. Not only that, you know, we've talked about this many times in the channel. Job openings have been deteriorating. If you take a look at unemployment rate, it ticked up to 4.3%. Unemployment claims. Nick, how the heck can you justify being bullish on the stock market? This looks horrible. And it really does. It does actually look not good. Now, please understand that where we are with the labor market is not in a terrible spot because, again, unemployment rate at 4.3 may sound, scary when you look at this chart, but it is a historically low number. I think the average unemployment rate in the United States is like 5.7. So we are still very well below long-term historical averages with rate cuts to come. So yes, unemployment rate is looking a little more threatening. And yes, we see that starting to trend. But there are some things that I point to that are actually more on the bullish side. So before we get into a bunch of fancy charts, I just wanted to, go through some basics. GDP growth, for example, is one that looks a little promising. You can see that relative to forecasts, which the forecast for advanced GDP was 2% consensus, actually came in at 2.8%. So what you'll see here is that we had a really upbeat GDP figure. And again, if you're looking at the economy, GDP is a very good metric to look at. And so what we have is the GDP report coming in higher than expected, showing some optimism. So was the jobs data bad? Yes. But GDP was pretty good. But here's the thing that a lot of traders miss when they're talking about ideas for, whether they're bullish or bearish. They look at one thing only. They look at one specific indicator that says a recession is coming, or they look at another one that says a recession is never coming, right? You have to be careful. And one thing that I like to do is I like to look at the summarized view of things. So what I'm going to do here is I'm just going to filter for indices just for a moment. And you can see that the Dow Jones is the only US index that's getting a bullish reading currently. The other ones are getting bearish readings. And largely attributed to that is the commitment of traders data, which we will look at in this video. But you can see GDP is pulling some weight. These are getting negatives. The PMI numbers not positive for the US. Especially manufacturing PMI this past week was terrible. Retail sales beat. Inflation has shown a lot of progress, which is no longer even a real big problem for the market. It seems like everybody is convinced now that inflation is beaten. But now we have the labor data, which is these two ones, which are hurting us. So what you can see here is there's a mixed bag on the U.S. economy. We have in the U.S. economic kind of report, we have a couple things that are looking positive. Also, by the way, interest rates falling, generally speaking, pretty good for stocks because that's telling you that the borrowing costs, that especially looks good for the Dow, by the way, because it makes dividend companies look a little bit more attractive. Now that yields are going down, people can't get as much out of bonds, so maybe they'll go into dividend stocks, which is a lot of what the Dow is. Anyways, so you can see there's a mixed bag here on the U.S. economy. So why am I not outright bearish? Well, because a lot of my indicators here are holding up. GDP, inflation statistics look good. Retail sales are beating interest rates. But again, I can't ignore that there are some bearish things creeping up. Labor data points were terrible. That takes 2 points off the top. And then PMI is terrible, taking 2 points off the top. By the way, we get an updated view, however, on services PMI. And if this comes in strong on Monday, I imagine that there could be a strong bounce back in the stock market. So let's go take a look now at the chart. Now that we know that I'm generally bullish on the Dow Jones, I am also bullish on the other indices as well, but they've fallen off just slightly. I think there's just some slight, in fact, let's take out the neutrals or add in the neutrals and you can see, yeah, so NASDAQ and S&P 500 are very close to a bullish reading. So I am bullish on all three. The Russell I'm going to pause on because it just got absolutely hammered on Friday. And you can see here's the Russell, right? Russell just got smacked. I actually tried to go long here, ended up completely failing out on that idea. So anyways, let's talk a little bit about the stock market. So if I take a look at the indices and I apply some moving averages, you can kind of see what's going on here. The stock market is still in a very strong upward trend. So before we get too bearish, let's not forget that uptrends prevailingly keep trending up, right? If we were to just apply trajectory to this, right, it would be pretty fair to say, well, look, the chart's still going up, even if you drew it this way or if you drew it this way, however you want to slice it, it's a uptrend. And that means a lot because, again, when equities are doing well, they typically keep doing well. So anyways, we've pulled back all the way to what I think could be an entry point that looks interesting, which is the 53.35 level, which lines up nicely with the 100-day moving average, and a key level of support is right below. Not only that, we have, this level here this is the previous pullback highs, March, right before the April sell-off. So we have some support there. We also have support here where we broke out of and kind of went on this big run to the upside, this big bull run right around June 5th. So yeah, I think that you're kind of looking at an interesting level of support when you look at the indices. I also am very bullish on the NASDAQ and went long the NASDAQ on Friday. Now, let me not shy away from this. I've been really early to this pullback and I've gotten a little bit of criticism on my YouTube channel and Twitter and stuff like that, which is nothing new. Anytime you put yourself out there with this sort of stuff, you're going to have people who criticize you, and that's totally fine. It's part of the territory. But I bought the NASDAQ too early, right around here and here and here. So I've had 3 attempts on the NASDAQ, and you can see this one was a heartbreaker for me because what ended up actually happening was this entry was so perfect. We bought right around there. Market went sideways and then shot up a 3% day in a single day for the NASDAQ, which is very rare, one of the best days in recent history. And then the market proceeded to fall through those levels, stop me out. So why did I take another entry? Well, because I'm still bullish. I still think that if you actually look at, generally speaking, company earnings have been pretty good, especially for some of the big players. So let me go through some of that really quick on NASDAQ. So if I take a look at, for example, Apple, which reported their earnings, Apple came in with pretty good earnings, right? Not bad earnings, nothing catastrophic here. And I will show you the good ones and the bad ones. So I'll show you that too. Microsoft, another big company. Their earnings came in better than expected. There was a little bit of AI spend that was a little under question, but overall you can see not a terrible reaction. And That's kind of what you're looking for with these guys, right? They're held to such high standards. You just don't want to see them fall off a cliff. Here's one that wasn't so good. If we take a look at Google. So take a look at Google. Google's earnings came in better than expected, but the stock dropped. So not particularly ideal. But again, these things are held to such a high standard. And here's a bad one, right? Amazon, not great. Amazon dropped, and they missed on their revenue, which is concerning for the economy for sure. If you want to get scared about the economy, here's another one that is scary. Here's UPS, right? UPS fallen off a cliff recently, missed their earnings, and they don't do that, right? Look, they have not missed their earnings in a long time. All the green E's, that represents earnings beats. So UPS does a lot of shipping, right? They do a lot of packages and stuff like that. So UPS being hit so hard is a little bit concerning, I'm not going to lie. But again, the market tends to get the loudest and most scared about a recession at the worst possible times. By the time the stock market has already sold off some and recession fears are already becoming mainstream, a lot of times the smart traders that were bearish up here have probably already started to, look ahead from now. Remember that the market is always very forward looking. What I mean by that is that, the market is always thinking 6 to 9 months ahead, right? And so if concerns about a recession have now become the mainstream, big players that are really smart about the markets, they've already been concerned about that for some time. So some of it may be baked in, and I personally think there's a good chance that this is a bit of an oversold condition. Now, if I'm wrong about that, that's why I put stops on my trades, because if I'm completely wrong and this thing blows through the lows, I got to get out of there. But again, I think there's a good chance that we're a bit oversold here, that the market is not dead, and that earnings will bounce back as long as GDP growth continues to stay strong. And hey, maybe that was just one bad labor data point. Maybe it's not the end of the world like everyone on Twitter is getting super excited for. I personally think that this stock market will see new highs within 12 months. I don't think that, that has changed just because we've had, a miss in the jobs data. And you might say, well, this market is overbought. Well, typically, strong markets look pricey until they look way too expensive, right? But trying to say, oh, this market is, too expensive and can't go higher. Well, you're kind of forgetting that one of the reasons that it is considered as expensive is because these companies make more money than they ever have. They're super, super powerful companies that, dominate the NASDAQ, dominate the S&P 500, and they deserve to trade at a premium, especially if we do see rate cuts and the economy hold up. Those companies deserve to be priced very richly, in my opinion. Anyways, the Dow Jones, I also had a bullish position on this one. Really a bummer on this one because this one entered right there. We saw price shot up, and it was such a nice trade. Then market came all the way back down and ended up closing me out for a loss. So a little bit of a heartbreaker there last week for me, but it is all good. I took a small, haircut on the account overall. My drawdown during this period was down 3%, which, 3% is not nothing, but it is certainly a lot better than, if you're leveraged or margin trading heavily. It could have been much worse than that. So I personally stick away from that. And sometimes, margin and leverage are a tempting thing, even when you do have a, pretty large capital basis, like I'm fortunate enough to have. But I'm telling you, when times like this happen where you're just dead wrong, it feels very nice to not be using leverage and actually just stop out of trades quickly and take controlled losses. So although it was not a profitable week for me last week, I'm very grateful that I stuck to my plan, strategy, stop losses, etc. Anyways, let's talk a little bit about gold. I actually did go long gold. I discussed this thoroughly on yesterday's video. So if you're looking for even more gold-centric coverage, make sure to check out yesterday's video. I did a full breakdown on why I am pretty bullish on gold. And the summary is, remember how I showed you the labor data looking rough? Well, even though I do still think that the stock market could bounce back and that we could have still a soft landing, I do want to also reiterate that I do have a bit of a mixed view on that and a hedged position by being long gold. Because again, that unemployment data, although it's not good for stocks, it's kind of good for gold because economic data coming in really soft or cool or even showing signs of a possible recession are bullish for gold. A big miss in economic data makes people think, oh, I need to hedge some bets and get long into gold, or just very simply, I want to buy something that's not so correlated to the stock market, and gold serves that purpose beautifully. And so I put a good bit of my account into gold on Friday, and we're in a nice trade so far. Bought this off the 4-hour chart. Price came down to this 24.20 level, and then I was watching it, and I went ahead and just picked up a long position as it tapped into this area, and nice little start to the trade. We'll see where that one goes. If this breaks through the lows, then I'm going to stop out of that, but I like that 61.8% and the 50% level on this 4-hour chart pullback. So, if it runs through the highs from here, which I think it has a good chance of doing after all of that concerning news that came out on Friday, then I'll hold on to this trade and try and trail stops, catch a little bit of a winner here. If I can't, again, I'll stop out and take a controlled loss. But I like gold a lot. Again, with gold, what's the bull case here? Well, the bull case is that now with the rate cuts becoming a we need rate cuts story, that's going to be very bullish for gold, because rate cuts that are optional rate cuts, like, oh yeah, a rate cut would be nice, is very different than, oh, we need a rate cut to save the economy, right? Or many rate cuts to save the economy. That's what people were getting all scared about on Friday. Now, again, do I think we need to have, 17,000 rate cuts in order to save the economy? I personally don't. I think that, that GDP number is a nice, thing to look at. Earnings overall have been pretty good for the stock market as a whole. So as long as earnings hold in there and GDP statistics are coming in, showing some considerable growth, there is a possibility that, the stock market bounces back and that gold, still could go up off of rate cuts. But maybe the dollar index was a bit oversold as well on Friday. Here's the thing. I don't think that the U.S. economy is in a terrible spot, but you'll see that the stock market sold off in tandem with the dollar index. Because why? The economy concerns. This is where you have to be, if you really understand the fundamentals, you understand that the dollar index totally can go down on the same day as the NASDAQ and the S&P. Sometimes people get that mixed up. They think, oh, dollar down, stocks up. But it is not that simple, because, again, you have to think about what this means for the Fed. And the Fed is what impacts the stock market. So this dollar movement on horrible jobs data is not good for the stock market, because, yes, the Fed will cut rates, but it could mean the economy slowing. And if the economy is slowing meaningfully, what does that mean for stocks? It means earnings go down, right? But again, I'm personally in the camp that I think that earnings can actually stay strong and that the economy is not falling apart. If I'm wrong about that, again, we'll pivot. But I have a position in that kind of hedges me on that idea. I am long gold, which, again, benefits from weakening economic data. And I'm also long NASDAQ, which obviously benefits from the economy staying strong and rate cuts coming into the picture. Rate cuts, and I will say the NASDAQ idea is a risky idea. It's sensitive, because if the Fed does cut rates very quickly, but it's because the economy is falling apart, the NASDAQ could very easily make a move down much, much lower. And so I want to be clear that I'm not risking my whole account on this idea. I'm not taking huge leveraged bets. Oh, I'm, very certain the NASDAQ's going up. I'm definitely not there. I'm taking little stabs. And yes, I've taken a couple losses here. But again, I mentioned I'm down 3%. I'm not, leveraging my whole account trying to go long the NASDAQ. And I think that a lot of traders who listen to videos and social media, they hear people have these ideas and they think that they're just certain about them working out, and that because they have a big following, they just know what's going to happen. And I'm telling you, I do not know what's going to happen with the NASDAQ with certainty. I have what I like to refer to as an educated guess. And in trading, this is all that it's about. Educated guesses, managing your risk appropriately. And that keeps you in the game for times like this for me, when I've just been wrong about a lot of stuff. So when I'm wrong, I stay in the game. When I'm right, I make as much money as possible. When I'm wrong, I lose as little money as possible by being, by managing my risk, right? That's the key to this game. Everyone is focused when it comes to trading on the gains. They want to make as much money as possible. But professional traders are focused on minimizing their losses. That is the key. If you listen to a professional blackjack player, which I compare trading oftentimes to blackjack, and I'm not a professional blackjack player by any means, but I know how I've watched a ton of people who discuss blackjack. I know some people who play blackjack very, very well. And blackjack is a game of pure odds. And if you know how to count cards, you can actually put the odds in your favor by about 51% of the time you win a hand. And with that 1% edge, blackjack players can make a ton of money over time against the casino. So my point with saying that is they don't know on every single hand if they're going to win or not. But over many repeated iterations, they're eventually going to make a ton of money. And that is how I view trading as well. I'm not certain about any trade that I take. One trade to me is meaningless. It is all about the net results of many, many trades to come from that. I also want to mention, guys, that we have a Telegram channel down below in the description. If you have not already joined that, it is free to join. There's also a Discord. And finally, if you're looking for a new brokerage, a lot of the brokerages that are you can actually trade directly on TradingView are linked in the description down below. So if you want to trade directly on TradingView, it is super convenient to do that. And also, there's some special sign-up perks with each broker listed in the description down below, like deposit bonuses, things like that. You can find out more information. Just pop open the description, go shopping there. These are all free things, by the way. You can join the Telegram, Discord, sign up for a brokerage. All that stuff is free. Check all that out in the description. That's all I ask if you made it this far in the video. See if there's something there that helps you out. And of course, it will also help out the channel as those are affiliate links. So thank you guys very much for tuning into today's video. Have a great trading week ahead.